Welcome to Understanding Key Ratios. Upon completion of this training, you will be able to explain the significance of key financial ratios in assessing the financial health of a farm, including liquidity, solvency, profitability, and repayment capacity. Calculate and interpret the 4 key financial ratios. Analyze a farm's financial health by applying the calculated ratios to real-world scenarios. Determine the farm's ability to handle short-term obligations, generate profit, manage debt, and sustain long-term operations. And use financial ratios to make informed decisions regarding farm management. Now that you've prepared your 3 key financial statements, the balance sheet, income statement, and cash flow document, and calculated your cost of production and cost of family living, you're ready to put this data to work for the benefit of you and your farm by using 4 key ratios. Ratios are like the pulse check for your farm's financial health. They're simply calculations based on your financial data that help you see how your farm is doing from one year to the next, or even how it stacks up against other farms like yours. In addition, there are many different ratios you can calculate to uncover a variety of insights about your farm. While ratios and calculations are important indications of your farm's financial status, 1 or 2 ratios alone are not indicators of success or failure. Every farm is unique, and no single set of data points will be ideal for every farm. In general, ratios fall into 4 categories: liquidity, solvency, profitability, and repayment capacity. Let's look at each of these in greater depth. The first key ratio measures liquidity. Liquidity is the farm's ability to pay normal operating expenses as they come due, including family living expenses and debt payments. Your balance sheet is needed to calculate liquidity, expressed as current ratio. This ratio gives you a snapshot of how your farm can handle its short-term obligations with its current assets. The second key ratio measures solvency, which is the ability of your farm to pay all its debts if you were to sell it today. Solvency is measured by calculating the equity to assets ratio. This ratio reveals the percentage of your farm's total assets that you actually own. This is especially important when you're considering new loans. Just like liquidity ratios, this information will come from your balance sheet. The third key ratio measures profitability, which is your business's ability to generate revenue in excess of your expenses. Profitability ratios demonstrate how your farm is making money each year. The ratio for measuring profitability is operating profit margin, which shows you what portion of each income dollar from your farm turns into profit. To calculate this ratio, you will use data from your income statement and divide the net cash farm income by the gross farm income. The fourth key ratio measures repayment capacity, which gives you a sense of your farm's ability to generate enough funds to make payments on intermediate and long-term loans. The capital debt repayment capacity, or CDRC, reveals how well you can use your earnings to handle debt payments plus capital replacement plus liquidity maintenance. To work out this ratio, you'll want to utilize your cash flow statement. These ratios help you understand if your farm is in a good position financially to repay term debts on schedule. Let's look at each of these in more detail, using some examples. Current ratio, which measures liquidity, reveals how much of your current liabilities you could pay off if you were to sell all current assets today. For example, if your current farm assets are $442,500 and your total current farm liabilities are $320,450, your current ratio is 442,500 divided by 320,450, or 1.38. A ratio of less than 1 means you wouldn't have enough cash from your current assets to cover all of your current bills and loan payments. Ideally, you want your current ratio to be more than 1. But hey, farming has its seasons, right? So there may be times when this isn't the case. It's good to remember that a single balance sheet alone is like selfie. It's just capturing one moment in time. It does not tell the farm's whole life story. For many farms, a current ratio of 2 or higher would be a comfortable number to target. The equity to assets ratio, also known as owner's equity, measures solvency. The owner's equity reveals what percentage of your farm's total assets actually belong to you. For example, if your total farm assets are $3,780,000 and your farm net worth is $2,450,000, $408,350, your equity to farm asset ratio is $2,408,350 divided by $3,780,000, which equates to 63.7%. If your operation is profitable over time, you would typically see the equity to assets ratio go up as you gain more equity in your farm. However, if you were to purchase additional assets or plan an expansion, this ratio may go back down until you're able to pay off more of that new debt. For young producers, if your farm operation isn't currently growing or shrinking, a good target is for your equity to asset ratio to match your age. However, this can vary depending on when you entered the business, when you took over majority ownership, and other factors. The inverse of your owner's equity is the debt to asset ratio. This tells you how much of your farm assets are tied up in debt. To get this ratio, divide the farm net worth by the total farm liabilities. The sum of your owner's equity and your debt to asset ratio should equal 100%. Operating profit margin, also called operating margin, measures your operation's profitability by comparing your farm's net income profit to its gross income. For example, if the net cash farm income is $73,227 and the gross farm income is $314,920, the ratio would be $73,227 divided by $314,920, which is 0.2325. In this example, the calculation shows that 23 cents of every income dollar could be profit. This is money that could be used to pay off the principal of term debt, cover living expenses, or saved. Operating margin is just one of several ways to measure profit margin. This number is especially helpful in managing your farm's day-to-day operations. You can easily play with your expense numbers to see how spending more or less will affect how much of each dollar earned stays in your pocket. For example, say you're thinking about bringing in another part-time employee on the farm. You can slot in their labor expenses and see how it changes the amount of each dollar you get to hold on to. This can help you determine if hiring more help is a cost-effective and beneficial move. Remember, some factors in your operating profit margin are not under your control. Unless you're locking in your prices and using risk management tools to guarantee a minimum price for commodities, your operating profit margin is vulnerable to price fluctuations and can easily change. The last key ratio, capital debt repayment capacity, is a bit trickier to calculate and involves 3 steps. Step 1 is to add up your net farm income plus depreciation plus term interest plus non-farm income. Then, subtract owner draws and income tax from this total. Step 2 is to calculate principal plus interest on term debt. This equals the sum of working capital deficiency plus capital asset replacement. Step 3 is to divide the result of the first calculation by the result of the second calculation. In this example, this would be $94,077 divided by $73,700 equals $27.65, which translates to a capital debt repayment capacity of 127%. The capital debt repayment capacity, or CDRC, is like your farm's finance compass. Essentially, the CDRC is your farm's ability to meet its debt obligation and maintain the farm's balance sheet. Each business operates with different abilities to manage debt, and this ratio provides insight into how well you can handle your current debt level. It's a crucial indicator of whether you're positioned to take on additional debt to grow your business. We've covered a lot. Before we finish, let's check what you've learned. Liquidity is the farm's ability to pay bills as they come due, including family living expenses and debt payments. Which ratio would you use to evaluate your farm's ability to handle its short-term obligations with its current? Current ratio gives you a snapshot of how your farm can handle its short-term obligations with its current assets, and is determined by dividing total current farm assets by total current farm liabilities. Profitability is a comparison of your farm's profit relative to its expenses. Which ratio would you use to demonstrate how your farm is making money each year? Operating profit margin shows you what portion of each income dollar from your farm turns into profit. To figure this out, you'll divide your net cash farm income by your gross farm income. Solvency is the ability of your farm to pay all its debts if you were to sell it today, which ratio shows what percent of your farm's total assets actually belong to you. The equity to assets ratio, or owner's equity, reveals what percent of your farm's total assets actually belong to you. To find this ratio, you will divide the farm's net worth by the farm assets. Now that you understand how to use key financial ratios to determine liquidity, solvency, profitability, and your repayment capacity, you can use that information to gain insight into the financial health of your farm. Using the data from your balance sheet, income statement, and cash flow statement, as well as your calculations of cost of production and cost of family living, you will have the tools to evaluate how your farm is doing from one year to the next, or even how it stacks up against other farms like yours. Now that you understand how to use key financial ratios to determine liquidity, solvency, profitability, and your repayment capacity, you can use that information to gain insight into the financial health of your farm. Using the data from your balance sheet, income statement, and cash flow statement, as well as your calculations of cost of production and cost of family living, you will have the tools to evaluate how your farm is doing from one year to the next, or even how it stacks up against other farms like yours.